the reality of the next 5 years and beyond is that we're going to have low global growth. I think that's pretty much a given. We're going to have low inflation, would also appear to be a given, and we're also going to have low interest rates. It's pretty hard to see any change to that because we've got this incredible debt around the world, which is more than 2 times bigger than it was in the GFC. We've got all these demographic factors around aging populations and what have you. And then we've also got a very, very new and very powerful theme of protectionism around the world, which is, really coming from the rise of populist policies. So they're the things that aren't going to change, and they're the things that are going to create the low global growth and low inflation, etc. And that's why companies with growth driven by really strong secular themes are so vital. If you fall into the trap of looking for companies that have just got low PEs, the low PE is probably there for a reason. That's because they're low growth. And if you're low growth in this sort of world we're going to have in the next couple of decades, then you're at risk of going backwards. It's the old story of if you're not growing, then you're dying. So many traditional companies that people would regard as safe and secure for their superannuation funds are going to get left behind. And I believe this is where the risk is. The risk is not in high PE stocks per se. The risk is in stocks that don't have growth and quality and low debt. So that's what you want to be looking for. So that's a completely different question to the PE ROE question. Conventional assets, so holding conventional assets and traditional thinking in this world that we're in now is just not going to cut it. And I'm absolutely crystal clear in my mind about that. So if we want to look at what effective fundamental analysis is, so these are, hopefully, Roman, I'll give you a bit of a sense of the level of fundamental analysis that's really effective. The critical elements are that the metrics you look at must be in context. Otherwise, it's pointless. You can't look at a stock's PE ratio today and draw a conclusion because you don't know is that PE relative to the environment they're in that's growing or shrinking. Is the PE a good one this year, or is it on the decline? So you've got to look at it in context. And the second point is that a single data point is completely useless or almost useless. Trends are everything. So you need to look at 3, 4, 5 years worth of data to be able to draw any sort of conclusion at all. And that's what you'll see in the analysis that I do in this service. Predictability and sustainability of future earnings, they're the things that are important. So you've got to look for companies that have got growth drivers that will persist. And there's many industries that you can identify that fit into that. And I will address that a little later. So predictability and sustainability of future earnings are just so important. Much more important than PE. The management record and the management's motivation. Are the managers incentivized to build the business and grow the earnings and grow the share price, or are they just incentivized to do things in the very short term? So the management record and management ownership is really important. The next thing is don't be pedantic about the analysis. So if you've got, if you do a analysis of PE and a stock, it's not an in or out situation. It's got to be a weight of evidence approach. You want to look at PE, you want to look at ROE, you want to look at debt, you want to look at cash flows. You want to look at all of those things that that go about indicating a really good growth company for the future. So what does a good business look like? The bulk of revenue is, and this isn't by any means a definitive list, but this is a lot of the really key points. The bulk of their revenue is either contracted, so it's contracted for 3 to 5 years, so it's going to be there, or it's recurring in nature. So it's a monthly subscription model, or it's an annual subscription model, whatever it might be. But that gives you the predictability and a level of sustainability of revenue in the future. They don't have to go out and win it year after year after year. The next thing is you want sticky customers. It's customers that stick around for a long time because the service becomes indispensable to their business. And that gives you less volatility in earnings. And that, if you've got less volatility in earnings, will give you less volatility in share price. So again, and I keep wanting to reinforce this point because it's so important that people start to shift their thinking. That is far more important than whether the PE ratio is high or low. It's just a completely different way of looking at it. Higher levels of cash flow, and ideally free cash flow, are really important to a good business. Capital light and scalable. I talked about that before. You build it once and you can keep selling it. A very, very efficient way to build a business. And if you do that, you end up with very high gross and net margins. And, that's really important. Whereas a lot of low PE stocks have low PE because they're X growth and they have low margins. They might have net margins of only 3 or 4 or 5%. It doesn't require much shift for a 3% margin to disappear. Whereas if you've got a 20% net margin and a 70% gross margin, it takes an awful lot of things to fall off the rails for you to become unprofitable. A low PE is often signaling structural decline or just simply unattractive prospects, which then lead to poor future returns. So low PEs can be extremely misleading. The next thing is the best businesses, I believe, of the next 10 years have got some sort of network effect. And you look at Facebook, you look at Amazon, you look at Afterpay Touch. There's just hundreds and hundreds of them that have got some sort of network effect that drives the growth of the business. And they're able to earn very high return on capital, and they've got durable competitive advantages that protect that. So that's what a good business really looks like.